Take a good look at your screen right now. This really shouldn't be happening. Today, January 16th, 2026, something extraordinary unfolded in the markets. The paper silver price tried its usual trick, pushing downward, capping any real upside. But this time, the mining stocks refused to play along. They simply stopped listening. After more than 10 years of tight control, the algorithm that has dominated and suppressed silver pricing just broke. Over the next few minutes, I am going to walk you through the internal market evidence, the hard numbers, that clearly show why the major banks and market makers have suddenly lost their iron grip over the silver mining sector. If you're looking at your chart thinking, oh, just another green day in juniors, then I am afraid you're missing what is shaping up to be the most significant structural change we be seen in this market in 2026 so far, maybe ever. Today wasn't a correction, it wasn't a crash. Something fundamentally broke. And if you own physical silver ETFs, or especially mining stocks, junior producers in particular, you absolutely need to understand exactly what occurred in just the last 6 hours of trading. Because this moment has rewritten the rulebook on how these markets actually function behind the scenes. So let me show you what almost everyone missed while they were focused on the headlines. Around 11:47 a.m. Eastern Time today, the Global X Silver Miners ETF, ticker SILJ, which tracks junior and mid-tier silver mining companies, experienced an absolute monster volume spike. We're not talking about a healthy increase or even a powerful rally day. Bloomberg terminal data reveals the volume deviation was 8 standard deviations above the long-term historical average. Let that sink in for a second. If you remember basic statistics from school or college, an 8 sigma event is supposed to be practically impossible in real-world financial markets, the kind of statistical freak that should only occur once every several billion years under a normal distribution. But markets aren't normal, and today proved it in spectacular fashion. Now here is the part that should make every viewer sit up straight and pay very close attention. While SILJ was rocketing upward on this historic, never-before-seen volume surge spot silver, the actual physical metal price that S supposed to be the primary driver for mining company valuations, was stuck in an extremely tight range of barely 50 cents, practically flat. No movement worth mentioning. Pause and really think about that contrast. Junior silver mining stocks are exploding higher with volume levels that dwarf anything we've witnessed in over a decade, while the commodity they actually produce and sell is sitting there doing nothing. That is not how free markets are designed to operate, and it is definitely not how the silver market has behaved for the past 10 years. What we were witnessing in real time is what I call a paper-to-physical fracture. A clean break, a dislocation between the paper pricing mechanism and underlying physical reality. These fractures are extremely rare, and they almost always appear right before a massive structural repricing event sweeps through an entire asset class. So let me break down exactly what's happening here. Because grasping this mechanism is the difference between brushing today off as just volatility and recognizing it for what it truly is, the opening act of a complete repricing of silver. For more than a decade, the silver market has quietly run on 2 completely separate tracks. Most retail investors and even many professionals never fully appreciate this dual structure. Track 1, the physical market. Real silver bars and coins change hands. Metal gets delivered into vaults, it gets fabricated into solar panels, EV components, AI server circuitry, 5G equipment. Actual industrial consumption. Track 2, the paper market. This is exponentially larger. Futures contracts, options, swaps, ETFs, unallocated metal accounts. Most of this silver doesn't physically exist anywhere. It's digital promises. Historically, the much larger paper market has dictated the price that everyone else, including physical buyers and sellers, is forced to accept. That's been the status quo. The algorithm I mentioned isn't some shadowy conspiracy theory or secret software. It's a very real, well-documented system of programmed trading strategies used by the largest banks and market makers. Research published by the Bank for International Settlements has confirmed how heavily precious metals markets depend on these high-frequency algorithmic responses to price levels, volume thresholds, and momentum triggers. The entire purpose? Whenever physical demand starts pushing spot prices upward too aggressively, the algorithms flood the market with sell orders and paper contracts, effectively slamming a ceiling on rallies before they can develop real momentum. But something changed today, and this change is huge. For the first time in more than 10 years, the mining equities, the actual ownership shares in companies that physically extract silver from the earth, have decoupled from that paper price control mechanism. They've broken free. We're now seeing a silent decoupling, mining stocks moving on their own logic, completely independent of the manipulated spot price. The equity market is screaming a message that the paper commodity market is being actively prevented from expressing. It's like watching a pressure cooker where the gauge is spiking wildly while someone desperately keeps their hand clamped over the release valve. Well, why should you care, even if you don't own a single mining stock? Because silver isn't just another shiny metal for jewelry. It is a critical industrial input for almost every major technology transformation happening right now. Artificial intelligence data centers, electric vehicles, solar energy, 5G, 6G networks, advanced electronics, medical devices. When a vital industrial commodity like silver goes through a violent repricing event, while global supply chains are already stretched to the breaking point, the downstream consequences ripple through every sector of the economy. Your retirement accounts with tech exposure, your plans to buy an EV, your investments in renewable energy, the price of your next smartphone, laptop, or home solar system. All of these will feel the impact. So let's zoom in on today's specific events, because January 16th, 2026 is not just another random trading session. According to options flow data from the CME Group, there is currently an enormous wall of call options clustered right around the $29.30 strike prices, with expiration at the close of trading today. Now, we're talking about massive open interest, representing tens of millions of ounces in notional silver value. The market makers and large institutions who sold those calls to speculators and hedgers are now in a very uncomfortable spot. They desperately need spot silver to stay below those strike prices to avoid a chain reaction of in-the-money obligations they might struggle to meet. Now imagine what happens if silver closes above $30 today. Every call that finishes in the money creates a delivery or cash settlement obligation. But here's the real problem fueling today, this 8 sigma volume explosion in the miners. There simply isn't enough physical silver available at current depressed prices to cover all those potential delivery demands if they cascade. So what are the smartest, most sophisticated institutional players doing right now? They've stopped fighting for scraps in the tightly controlled paper spot market. Instead, they were going straight to the source, buying equity ownership in the actual mining companies that control future production. That is precisely what the unprecedented volume surge in SILJ is showing us in real time. When paper promises vastly exceed available physical metal, the logical, indeed the only rational, move is to secure direct ownership of the companies that will produce the real stuff in the years ahead. This isn't wild speculation. The proof is sitting there in plain sight. The volume numbers, the options positioning, the glaring divergence between equity behavior and spot price action. Today, we watch the market successfully route around a failing control mechanism. You can print infinite paper contracts. You cannot print physical silver. And that hard physical limit has finally arrived. Let me leave you with this. What happened today wasn't the endgame. It was the first loud crack in a system that has been artificially holding silver down for over a decade. The algorithm broke. The fracture is visible. The repricing is coming, fast, violent, and unavoidable. Whether you act on this information or not, the market has already started to vote with real money. I'll be back Tuesday morning to see how much further the fracture has spread. Stay sharp out there. This is only the beginning.